This John Lothian news video is sponsored by money managers are always looking for innovative ways to trade the markets. Don Davis of Novus Investments says he's found one of them. Davis sat down with John Lothian News to talk about how his firm is finding opportunity in the peer-to-peer lending space.
The two biggest players in the industry are Lending Club and Prosper. Lending Club has plans to go public next year. So these are, for lack of a better analogy, let's say the prime brokers of the industry. They're the originators and the service providers. And then you have individual investors that can try to do it on their own, which is very difficult to do, or you can go through a fund. And so we have a fund. We were a relatively early adopter in the space a couple of years ago, and we have a fund that feeds into that. And so we have a dedicated API that kind of is tapped into the server that monitors all the different loans with a little bit of credit modeling and filtering, and we choose sort of the best bang for the buck. So they may have credit card debt that maybe they have $15,000, $20,000 in credit card debt they're paying high interest rates on. They can do a debt consolidation loan in the peer-to-peer lending space, get a little bit lower interest rate. It's a fixed loan, and they're all prime consumers. So even if times get tough, or even if they're unemployed, are they going to walk away from a $15,000 debt consolidation loan with a couple $100 monthly payment? Some of them will, and some of them always do. And that's part of the equation. But we venture to say most of them will not. And prime consumer credit has been very profitable for banks and credit card issuers every decade. And so what our fund simply seeks to do is be its own virtual private bank and do what banks and credit card companies do. We accrue estimated default reserves in advance, as part of the fund, and so every month that allows us to have positive returns because the estimated defaults are already accrued in advance. So you have very low volatility, high amount of consistency and predictability. It's all risk-based pricing. So a lot of it depends on the risk of the market. Right now you have risks that are coming down with prime consumer credit, and you also have voracious institutional demand. So with that high institutional demand and the decreasing risks, that's bringing the yields down. But most large investors are okay, even with 7%, if they can have very consistent low volatility returns. And that's kind of what we're looking to.